Welcome to the DIY Investing YouTube channel. Don't forget to like and subscribe to this video. We are working through all 500 of the S&P 500 and doing 5-minute quick looks. Today is Adobe Inc., ticker ADBE. We're using quickfs.net to do a 5-minute stock analysis. We begin by looking at industry and business description. We want to understand the quality of the business. This is software industry. Software generally is a good business to be in. You can have high margins and good sustainable revenue, but there's sometimes risk of not being able to forecast far in the future. So let's look at some of the details. So they provide digital media and tools and solutions to enable teams, individuals, and enterprises to create, publish, promote, monetize their digital content. Now, Adobe produces the PDF software. So it's flagship product, Creative Cloud. You have subscription services. So this is software as a service company. Again, very popular types of companies at these times. This is actually a really big company. It's $238 billion. So extremely large. Generally at this size, you'd think growth would be relatively small. We'll see how that plays out. A lot of information about all the different market segments they served. But generally, you can know that it's distributing products and services through distributed software vendors. It's selling products, okay? Software products from adobe.com. Beta is 1. This basically means it's going to go up and down with the general market, S&P 500. I'd like a low beta below 1, but it is what it is. Share turnover, 188%. This is very high. Not a sign that I like to see. It means there's not a strong shareholder base, more traders than investors. So return on invested capital. I want to see above 10%, but ideally in the 15% plus range. And I also want to see stability. This is a very unstable return on invested capital. Basically from the 2000s, you were very high up until 2005, and then you crashed. And then you have this period from 2009 through 2015 that you had low returns. Now, since 2015 and 2016, you started to get better and better returns. 12%, 17%, 21, 20, 20. So like the last 5 years look really, really good. But like, is this bottom going to repeat? I don't know in this 5-minute look. It would require further research. But in general, the recent returns are good enough to be acceptable. So if we look at the 10-year median returns, we see return on equity of 18%. Awesome. Like it. Return on assets, 11%. Good enough. So we're passing the bar here in terms of returns. But then when you get to valuations, I get immediately concerned. PE of 49. This is way too high of a PE to pay for a $200 billion company. It's going to be very difficult to justify this PE with the growth rates that you need. Likewise, the price to sales of 15 means that this PE isn't just like out of nowhere. It's going to be very hard to get like a PE ratio of 15 if your price to sales ratio is 15. So something's very far off. Now, it makes sense why you have these high price to sales ratios when you have a gross profit margin of 86%, but that's typical for software as a service. You're going to have high gross profit margins, which is very good. It means that you aren't facing a lot of competition. To prove that out, we should see stable gross margins, which we do. You have 89%, 85, 85, 85, 86, 86, 86, 86, 85, 86, 88. So very stable gross margins. That's a good sign. And so you're seeing signs of a high quality business here, but you're paying up for it. You're paying 15 times sales. I would never pay more than 10 times sales for a company ever. So I'm not going to buy it at this price, but maybe at another price because it does look attractive in terms of quality. So let's look for operating leverage. And I think that's what we're seeing over the last 8 years is that somewhere in here, you see like in 2013, 2014, 2015, your margins start rising on an operating basis. So 11%, 18%, 25, 29, 30, 31, 29, 32, 36. So your operating leverage is really showing through, which is why you've grown from $1 in earnings to $10 in earnings for the last 10 years. And that would have presumably skyrocketed the performance of the stock. Because we see revenue growth of 14%, growing faster than assets, great sign. Earnings per share of almost 20% growth, great sign. So you have high growth, you have high returns, but you also have high valuations. So I would rate this as a high quality company, but overvalued. At a lower valuation, I'd be very interested. And so to me, this is something that would go on a watch list. I know the company, I know the product, it's a good product, but I have concerns about the prices that I would be paying. The only other thing you'd want to check is like the balance sheet. Do I have high debt loads? And it looks like they're relatively low. Yeah, so you have like $1 billion in debt, $4 billion in debt on a $200 billion company is basically de minimis. You're not concerned about that. And then the only other piece I want to check here is your income statement. What's happening with shares? So shares look like they went up for a little bit, but they've been decreasing since 2013. So that's a good sign. Again, I like what I'm seeing from this company. This looks like a good, interesting company, high quality. Adobe goes on my watch list. It's too high of a price to pay for now, but it's something I'd be interested in owning for the long term. Like this video and subscribe for more great videos.